S&P futures are down 1.5%.
Mm-hmm.
Nasdaq 100 futures have slid 1.8%. We're looking at a hard gap down at the open as we return from the long MLK weekend.
A very hard gap down.
It is Tuesday, January 20, 2026. The bell hasn't rung yet, but the implied open is, well, it's ugly.
It is ugly, but it's specific. We are looking at a market that is technically neutral, but psychologically, it's very fragile.
How so?
The VIX is still holding below 20, which tells me this isn't panic. Not yet, anyway.
It's paralysis.
It's paralysis, exactly.
No.
We are in this high-stakes standoff between a massive geopolitical headline and the earnings expectations we've all been banking on for Q4.
And we have to start with the catalyst. I mean, it's the one-year anniversary of the administration's return to the White House, and the headline dominating the terminal isn't tax cuts or deregulation, it's Greenland.
It is the Greenland Ultimatum. Over the weekend, the White House threatened a 10% tariff on 8 European allies. We're talking Germany, France, the UK.
The big ones.
The big ones, effective February 1st. And this is explicitly tied to the administration's push to acquire Greenland.
Which sounds like noise, right? Until you look at the pre-market movers. This is forcing a repricing of global export risk, and it's happening right now.
Instantly.
Look at the losers board. LVMH and BMW are both down over 2.5% in pre-market trading.
Exactly. Luxury and autos. Those are the canaries in the coal mine for a transatlantic trade war. The market is just dumping consumer discretionary goods that are vulnerable to retaliatory tariffs.
But look at the flip side.
You have to. Look at Frankfurt.
Rheinmetall, the defense giant.
Surging 3%. That is the hedge. The market is selling the global commerce trade and buying the geopolitical friction trade.
So investors are betting on sustained tension.
And, consequently, increased military spending. This isn't just about an island anymore. As the president heads to Davos tomorrow, the market is asking if this is the official start of Trade War 2.0.
Okay, so we have a gap down. We have this huge tariff threat. But you mentioned the sentiment is still technically neutral. Why aren't we seeing a full-blown correction here?
Because of the, let's call it the mission of this specific trading session, we are waiting for a reality check.
A reality check from earnings.
Right. Traders are weighing this Greenland geopolitical noise against the, $500 billion AI capex cycle that has been the floor for this market for 6 months. It's a tug-of-war.
Let's get into the macro mechanics, because there's a data point on the dashboard this morning that, frankly, it just doesn't add up.
I know which one you're talking about.
The dollar index, the DXY, is falling. It's down to 98.45. Usually a weaker dollar is a tailwind for multinational tech, yet the Nasdaq is leading us lower.
This is what we call a toxic divergence, and this is where retail traders are going to get hurt today if they aren't careful.
How so?
Well, the retail playbook says weak dollar equals bullish for tech. They see the DXY drop and they start buying the dip in software. That is the trap.
Because the dollar isn't falling for the right reasons.
Precisely. The dollar isn't falling because the economy is cooling or the Fed is dovish. It is falling because of that geopolitical friction we just discussed and, concerns over fiscal credibility. But the real executioner for tech isn't the currency. It's the yield.
The 10-year Treasury.
Look at it.
It's spiking. We're up 7 basis points to 4.29%.
That is the number that matters, 4.29%. We are seeing contagion here. It's coming from the Japanese government bond market. They're hitting record highs on their 30-year yields.
And that pressure bleeds over.
It bleeds over into treasuries. And on top of that, you have this Fed independence noise. The market is pricing in a risk premium because the administration is pressuring for aggressive cuts, and the bond market is, it's rebelling.
So the discount rate is rising.
And when the discount rate rises, valuations get crushed, specifically high multiple growth stocks. So if you are holding those growth at any price software names, the fact that the dollar is down is, frankly, it's irrelevant.
The discount rate is the executioner.
It's the executioner. We are seeing a real-time repricing of the Magnificent Seven.
It really feels like that group is fracturing.
It is. The pain trade today is retail buying that dip in software, expecting a currency bounce, while the smart money is fleeing those high multiples because of the yield spike.
So what's the threshold?
If the 10-year closes above 4.30% today, that is the key level. Expect a violent rotation out of tech.
Okay, so if the smart money is leaving software, where is it going? Because it's not just sitting in cash. We are seeing a very specific sector rotation in the pre-market.
We are. It's going to what I'd call the new tech.
You're talking about AI energy infrastructure.
This is the strongest sector on the board this morning. Nuclear, utilities, uranium miners. The logic is the AI power gap.
Explain it.
We spent 2024 and 2025 obsessing over chips, NVIDIA, AMD, all of it. But the narrative for 2026 is that the hyperscalers, Microsoft, Amazon, Google, they don't just need chips anymore. They need proprietary energy grids to run them.
So energy isn't a value play anymore.
No, it's a growth play. It is the new tech utility. We are seeing capital flow into these high-moat utility plays and uranium miners because the data center demand projections for 2027 are being revised upward.
The structural shift.
It is. The market is saying, I don't want to own the software company that might get regulated. I want to own the power plant that keeps the lights on.
Speaking of structural shifts and aggressive flows, I'm looking at a speculative name popping up on the scanner. Unusual Machines, ticker UNM. It's up 6% pre-market.
This is the speculative tip of the spear. It fits the whole domestic reshoring theme. As trade war rhetoric heats up, money flows into robotics and automated manufacturing.
Companies that help you build things here.
So you don't have to import them. UNM is a play on that.
The volume is massive relative to its average.
It is, but you have to watch the levels.
Yeah.
For the bulls, it needs to hold volume above $12.50 to confirm this isn't just a pop.
And the downside.
If it breaks below the $10 psychological floor, that signals a pump and dump and you get out. Simple as that.
Okay, let's pivot to the main event. The reason liquidity is drying up. Netflix earnings after the close.
This is the first big tech litmus test of 2026, the NFLX and anniversary session.
And the script has really changed, hasn't it? It used to be all about subscriber numbers. How many subs did you add?
Oh, that's yesterday's news. Saturation is here. The focus now is entirely on ad tier margins.
And they make money on it.
Can they monetize the ad-supported tier effectively? And the second thing, the rumor mill is spinning about M&A. There is a lot of talk of a bid for Warner Bros. Discovery assets.
The streaming consolidation war.
Exactly. Netflix needs to show they have a strategy to win that war. If they beat on ARPU average revenue per user and give us some signal on that M&A strategy, we could see a breakout.
The levels are clearly defined here. The strategy brief highlights a bull case level of $925.
That's the breakout. If ARPU beats, we go to $925. But look at the bear case. If content spend spikes, which is a huge risk with these consolidation rumors, and we don't see margin expansion, this stock could drop to $840.
Which would retest the 50-day moving average.
And it would drag the whole Nasdaq down with it. It would set the tone for the entire quarter. If Netflix fails, that AI fatigue narrative gains a lot of traction.
Before we get to the bell, one more earnings print just hit. DR Horton, ticker DHI.
The ultimate soft landing barometer.
Largest home builder in the nation.
This tells us how the consumer is handling these sticky mortgage rates. We know rates are hovering. We know the 10-year is spiking today. The question is, are people still buying homes?
So what are the levels on this one?
We're looking for $215 on the upside. That would mean strong starts and resilient margins, proof that the housing deficit is outweighing rate pressure.
And if they miss?
If they miss on new orders, if that number comes in light, we watch $192. That signals the consumer has hit a wall. And if DHI falls, it drags the whole homebuilders ETF, XHB, down with it.
So we have the macro, the earnings, the geopolitical noise. Let's bring it down to the tape. Bell is about to ring. How do we trade this? Let's look at the S&P 500 futures, the ES.
We are middling, just stuck between that psychological 7,000 barrier and the recent weekly lows.
The strategy brief has a very specific line in the sand for today. 6,950.
That is the pivot. If the S&P stays above 6,950, the bulls still control the narrative. They can argue this gap down is just a headline reaction and the trend is intact.
But they can't clear 7,000.
They lack the fuel. That 7,000 to 7,015 area is a concrete ceiling right now. Without a blowout report from Netflix tonight, there is simply too much supply and profit taking up there. We are not crossing 7,000 today.
And the floor.
6,885. If we break 6,885, we expose the 50-day SMA at 6,835, and that is where the algos start pressing the short side.
Okay, so what's the diagnosis from the desk? What's the state of play?
This is a liquidity trap.
Explain that.
Volatility is compressed. Dealers are pinned between 6,900 and 7,000 on the S&P. What happens in a trap like this, and you get wash and rinse price action.
Shaking moves.
The market will fake a breakout, then fake a breakdown. It is designed to chop up retail traders who are chasing momentum.
So the advice is, do not chase the 10.0 AM move.
Absolutely not. Do not chase the 10.0 AM ET move. Liquidity is being sucked out of the market in anticipation of Netflix. The volume will be thin, erratic, and dangerous until the final hour. This is a low-conviction environment.
Feels like everyone is just waiting.
They are. They are waiting to see if the 10-year yield crosses 4.30%, and they are waiting to see if Netflix can justify these valuations. Until then, you are just trading noise.
Let's summarize the strategy for the session. We have a gap down, neutral sentiment, but with some pretty bearish undertones from this tariff threat.
Correct. So the strategy is keep your size small. Keep your stops tight. Don't try to be a hero on a Tuesday following a holiday.
We're watching the S&P at 6,950. If it holds, we breathe. If it breaks, we look to 6,885.
And we avoid the dollar trap. Do not buy tech just because the DXY is down. You have to respect the yield curve.
And for those looking for action, the eyes are on the rotation. Out of software into AI energy infrastructure.
Nuclear utility.
And potentially that speculative play in unusual machines if the volume holds up.
That is where the smart money is hiding. They are building the grid, not buying the app. It's the macro theme of 2026, the build-out.
Right, the infrastructure phase.
The software is great, but it needs power, it needs copper, it needs uranium. The market is waking up to the physical constraints of the digital world.
And the geopolitical constraints of the physical world thanks to Greenland.
Everything is connected.
We are just minutes from the open. Final thoughts on the Netflix print tonight. We talked levels, but what's the gut feeling from institutional flows?
The flows are cautious. The options market is pricing in a big move, but the skew is slightly to the downside. People are nervous about that ad tier execution. It's easy to launch it. It's hard to make money on it without cannibalizing your premium subscribers.
So if they show cannibalization, they get punished.
Severely. But if they show net new revenue, then they are the king of the streaming wars, and they get the valuation to match.
All right, let's wrap this up. We have a wait-and-see vibe. It's a tug of war between the Greenland tariff fears and the AI earnings hope.
The synthesis is simple. The market is waiting for new information. It has the headline. Now it needs the data. And until we get the data, liquidity is a trap.
Final, actionable advice for the listener.
Don't force a trade. If the setup isn't there, cash is a position. Watch the 4.3% yield. Watch 6,950 on the S&P. And honestly, grab some popcorn for the Netflix call.
And I'll leave you with this provocative thought from the source material. We are all fixated on this tariff threat. But is this Greenland Ultimatum just a tactical leverage play, a bargaining chip for a deal? Or is today, January 20, 2026, the official start of Trade War 2.0? The answer might be waiting for us in Davos tomorrow.
The market will tell us.
That's the brief. Markets open in 5. Good luck out there.